What are 5 myths about investing that you may have come across? What are the things that people say, think, or do that stops them from becoming great investors? These are behaviors that are extremely common among all types of investors, and digging deeper into them will reveal why you should be a bit skeptical when hearing these myths. This video will cover 5 of them in no particular order of importance, so without further ado, let's get into today's video. The first myth about investing is that you need to manage your portfolio every single day. Staring at your positions and how they are doing on a day-to-day basis does nothing for your overall performance. In fact, it encourages you to make adjustments to them when you really shouldn't. If one of your stocks is doing really well, looking at your profit and loss every hour can affect your judgment and could even push you to sell your stock for a profit in the short run, but miss out on the real gains longer term. Sit on your hands and let your winners run. Staring at the chart all day, watching the graph go up and down, does absolutely nothing for your portfolio. What you should be doing is spending that time being productive, researching potential investments, understanding industry trends, and how the wider economy could affect the businesses you are invested in. That is time spent creating value for your portfolio, as you'll be armed with more information about the companies and industries you are invested in and will allow you to make better informed decisions in the future. The second myth about investing is that the market always goes up. This is true on average over a long period of time, but you can see negative returns in the short term. If your plan is to make a bit of money investing in the stock market, and you have a short time horizon of 1 to 3 years, it's not guaranteed that you will make a positive return on your investment, especially after factoring in inflation. Just take a look at how poor timing can affect returns in the short run if you get in just before a stock market crash. Many retail traders that have come to the market in the past few years have only ever experienced a bull market. When you zoom out from 2021 over a 10-year period, the March 2020 crash looks like a blip in the secular bull run. Generating returns and beating the index in a bear market, however, takes a much more active and nuanced approach and can separate the good investors from the great ones. The third myth about investing is that analyst price predictions are accurate. Those 12-month price targets, upgrades, downgrades, and analyst recommendations that seem to be given such a high level of significance shouldn't be solely relied upon if you're looking to make a decision on a stock. You can always use them as reinforcement for your investment thesis, and if an analyst recommendation is contrary to what you believe, maybe you should look into it more to see if there's something you may have missed. No one can repeatedly time the market to pinpoint when a stock is going to go up or down. And if they claim to be able to, then they are probably lying to you or trying to sell you something. We can make a fair assumption that over a long period of time, with the help of economic growth, that stocks will rise. After all, a rising tide raises all boats. But we simply do not know what will happen in a week, month, or even a year from now. There are too many variables to consider that are simply out of our control. Not to mention that analyst price targets and recommendations change on a quarterly basis, and sometimes even sooner when a compelling event in the business or economy takes place. You should always be willing to hear someone else's perspective on a stock, but when that comes in the form of a price target prediction or buy, hold, sell recommendation, always remember to think of the motive behind that. What does that person or business look to gain from influencing investors to make adjustments to their portfolio, rather than simply staying long in their current positions? The fourth myth about investing is that retail investors are uninformed and institutional investors are superior. Don't pay any attention to those who say that because you do not work for an investment bank or a private equity firm, that you are at a disadvantage in the market. Yes, they may have extensive research teams and large sums of capital to deploy, but they are also hamstrung by mandates and fund investment constraints. As a large player in the markets, they can also display inability to react to market conditions as quickly as an individual investor. Think of a large truck versus a motorbike. Which one has a better turning circle? As a retail trader, you may have noticed the potential that Tesla had as a leading player in the EV space, arguably the largest growth opportunity of a decade, and decided to invest heavily when it was trading at a fraction of its current price. Since then, you have experienced immense gains in your portfolio. An equity investor in a large institution may have spotted the same opportunity, but was limited to only a 5% max allocation in their portfolio due to controls in place in the company they work at. This regulation leads to diluted returns. If they want to get out of a stock but have such a large holding, it takes time to liquidate that position and can even move the market entirely, whereas you, as an individual investor, can simply sell your shares in an instant and move on. Agility and nimbleness are traits that retail investors underappreciate, and that can even give you an advantage over the largest of investors. Instant liquidity is a unique feature of the public equity markets, and as a retail investor, that can be used to your advantage. Finally, number 5 on our myths list is this idea that you can invest in either a growth or value stock, but not both. This idea that growth stocks and value stocks are separate from each other is nonsense, and you can find great value when investing in high growth stocks as well. Take Alphabet, Facebook, and Alibaba as prime examples of this. Facebook currently trades at a PE multiple that is actually lower than the S&P 500 while experiencing 30% year-on-year revenue growth. Alphabet is slightly more expensive, but still manages to display immense growth on both the top and bottom lines. Alibaba is another stock that trades well below its intrinsic value, having fallen over 50% from its all-time high. Markets consistently overprice and underprice companies all the time, and this mispricing can happen in sectors that are either deemed more growth-focused or cyclical, value-oriented industries. This mispricing cannot go on forever. Over the long term, market prices will correlate with underlying earnings generation, which is much closer to the intrinsic value of the business. This is where we, as investors, can find opportunities to invest at discounted levels. Finding a value play in a high-growth sector can provide an unprecedented opportunity. Prime examples of this are companies I just mentioned. I covered Alibaba in an entirely separate video, and if you want to check out how and why a growth stock can also be a value opportunity, I'll leave a link to that in the description below, or click on the banner in the top right hand corner to go there. So there you have 5 myths about investing. There are definitely more that we will revisit at a later date, but if you think of any that we didn't discuss here, comment down below what you think those might be. If you got value out of this video, make sure to give it a like down below to let me know, and consider subscribing to Wise Wealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.